All right, let's jump right into this explainer. Today, we're doing a complete teardown of one of the most highly anticipated food and beverage offerings hitting the market right now, the Milky Mist Dairy Food IPO. If you've been anywhere near a dairy aisle in South India recently, you've absolutely seen their paneer, their cheese, maybe their yogurt. But you know, as focused learners, we're going to look way past the shiny packaging and figure out what the numbers are actually telling us. We're going to rip open their prospectus, analyze the hard fundamentals, and see exactly how they stack up against the competition.
And we've got to start with this massive number, 1,553 crore rupees. That is the total size of this initial public offering. But honestly, what makes this company so fascinating isn't just the sheer size of the raise. It's the fundamental shift in their business model. They aren't just selling milk, they're selling margins. They've made this incredibly profitable pivot to premium, value-added dairy products, so they're operating way more like a fast-moving consumer goods company than your traditional dairy farm.
Okay, let's map out our due diligence journey for today. We'll start with Section 1, the IPO offer, move into Section 2, promoters and business model, then Section 3, financial growth, and wrap up with Section 4, competitors and margins.
Section 1, the Milky Mist IPO offer.
As you can see right here, there is a very heavy institutional focus. A full 50% of the offer is reserved for qualified institutional buyers, or QIBs. Retail investors get a 35% quota, and high net worth individuals take up that remaining 15%. Now, this structure is pretty standard for a 100% book-built offer of this size, but it sends a really clear signal. The company is actively hunting for strong, stable institutional backing, the smart money, right out of the gate to anchor this valuation. So, the crucial question here is, where exactly is all this fresh cash going? Out of that 1,553 crore total, 1,428 crores is a fresh issue, and the allocation tells a very specific story about their current financial health. The single largest chunk, nearly 497 crores, is earmarked straight for debt repayment. Keep that number in mind because we'll see exactly why that debt is sitting there in just a minute. Another 469 crores will fund capital expenditure to expand their massive Parenderai manufacturing facility. Plus, about 155 crores will be deployed for visibility infrastructure, basically rolling out those visicoolers and freezers across retail stores to completely dominate shelf space.
Section 2, promoters behind the brand and business model.
They are raising massive capital, but who is actually steering the ship? The company is led by its key promoters, Sathish Kumar T., the chairman and managing director, and Anitha S., the whole-time director. Sathish Kumar brings over 27 years of deep industry experience to the table, and Anitha brings over 24 years. This longevity is absolutely crucial in dairy. It's a sector where building procurement networks and mastering cold chain logistics literally takes decades. Since starting as a simple partnership back in 1998, they've scaled this into a corporate powerhouse. It's also really important to note that post-IPO, they are keeping serious skin in the game. Their promoter's stake is going to dilute from 93% down to a still commanding 79.52%, so leadership remains heavily aligned with shareholder success.
The strategic vision of those promoters is defined by what we like to call the premium pivot. Traditional dairy businesses usually rely on selling massive volumes of highly perishable liquid milk, which has razor-thin margins. Milky Mist, on the other hand, does not sell liquid milk. 100% of their dairy segment sales come from value-added dairy products. We're talking packaged paneer, cheese, yogurt, and ice cream. Liquid milk is often subject to local price controls and fierce, everyday competition. But premium paneer and cheese? Not so much. This completely shifts their financial DNA from a high-volume commodity business to a premium, fast-moving consumer goods model. And because they exclusively sell these premium products, they hit this fascinating metric. Milky Mist commands a realization of 77 rupees and 79 paise per liter of milk procured. That is the highest realization per liter of milk compared to literally any of its listed peers for fiscal 2026. Think about it. By turning raw milk into high-protein Greek yogurt or specialized cheese, instead of just putting it in a plastic bag, they are extracting the maximum possible value out of every single drop.
Section 3, valuations and financial growth. Now, let's look under the hood because this financial trajectory is genuinely staggering. From fiscal 24 to fiscal 26, top-line revenue exploded from roughly 1,826 crores to over 3,145 crores. We're looking at a compound annual growth rate of over 31%. But the true compounding magic of that premium strategy, it's hidden down in the bottom line. Just look at the profit after tax. Profit jumped from a modest 19.44 crores in FY24 to an incredible 127 crores in FY26. That is an explosive 176% growth in net profit in just a single year from FY25 to FY26.
Now, what's really interesting about this is how that explosive profit translates into efficiency. Return on equity, or ROE, measures how effectively a company generates profit from the money shareholders have actually invested. Milky posted a phenomenal ROE of 32.12% for fiscal 2026. This proves that prioritizing high-margin consumer goods over basic commodities is an incredibly effective way to turn capital into wealth.
But we always have to employ the yes, but technique. Yes, the growth and returns are incredible, but they achieved this rapid scaling by carrying a very heavy debt load. Their debt-to-equity ratio sits at a remarkably high 3.61. That means for every single rupee of shareholder equity, they're holding 3.61 rupees of debt. In a high-interest rate environment, servicing that kind of debt eats directly into those premium margins we were just praising. Leverage like this definitely demands strict investor scrutiny.
If we look closely at the restated consolidated statement of assets and liabilities, you can see the sheer reality of that leverage. Their total borrowings hit roughly 1,672 crore rupees by the end of March 2026. And this brings us right back to that IPO allocation we discussed at the start. It perfectly explains why the single largest chunk of their fresh IPO funds, almost 497 crores, is being rushed straight to the balance sheet to pay down this specific debt burden.
Section 4. How competitors stack up. So how do they look next to the rest of the market? Well, there's a stark contrast in business models. Milky operates exclusively on that 100% value-added model. But if you look at heavyweights like HATSUN, AGRO, and DODLA dairy, they still rely heavily on traditional, lower-margin liquid milk sales to drive their massive revenue volumes. Milky is effectively playing a completely different game here. They are targeting urban, high-income consumers with products like paneer and specialized yogurt, rather than fighting tooth and nail over daily milk deliveries.
And this brilliantly illustrates why that strategy works. The proof is right there in the operating margins. When we compare EBITDA margins, Milky leads the pack at 13.87%. Contrast that with HATSUN Agro at 11.84%, DODLA Dairy at 10.20%, and Parag Milk Foods all the way down at 8.50%. Stepping completely away from the commodity liquid milk business directly translates into superior, industry-leading operating margins that honestly rival traditional packaged food giants more than standard dairy farms.
Section 5. Key takeaways for investors.
Okay, let's bring all these threads together for the explainer summary. The company has some exceptional fundamentals, featuring a massive 176% PAT growth and 31% revenue growth leading up to FY26. Their 100% value-added product focus gives them industry-leading 13.87% EBITDA margins, easily beating out major peers like HATSUN, DODLA, and Parag Milk. Plus, they're guided by a promoter team with nearly 3 decades of foundational industry experience. However, we can't ignore that this explosive growth was fueled by significant leverage, resulting in a high 3.61 debt-to-equity ratio, which, to be fair, the IPO is partially designed to fix.
So ultimately, this teardown leaves us with one critical question. Does their aggressive, high-margin, premium product focus justify the current debt burden and the valuation they're asking for? They're definitely growing faster and operating more profitably than their traditional dairy peers, but that balance sheet carries real, undeniable weight. Use this data, dig deeper into the prospectus, and decide for yourself. Thanks so much for joining this explainer, and as always, keep learning.